Another week of volatility is playing out across the markets, driven largely by continued swings in oil prices and lingering inflation concerns. As tensions surrounding the war persist, investors are grappling with the uncertainty around how long this conflict may last and what it means for global energy supply. Good afternoon. Things are getting more and more volatile as we get deeper into March. Last week, we saw an additional escalations in the war with Iran, as well as a Federal Reserve meeting and comments from Jerome Powell regarding the state of the economy. At the same time, rising oil prices are adding more inflation pressure, which makes things tricky for the Fed as they try to balance everything out. Even though we're starting to see some signs of the economy slowing, inflation tied to energy is keeping markets on edge. We saw that play out in a big way on Friday, one of the largest intraday swings since the rate hikes back in 2022. Mortgage backed securities dropped about 68 basis points, and at one point were down nearly 98 basis points on the day. A lot of that move was driven by the 48-hour ultimatum from President Trump to Iran, along with growing concerns around the Strait of Hormuz. If that remains restricted, it creates a real risk for global oil supply, especially if production has nowhere to go. We are seeing a bit of a rebound to start the week as talks with Iran have supposedly shown some progress and additional strikes have been paused for now. But this situation is still very fluid and changing day to day, and it has real implications not just for our economy, but globally, especially with how critical energy flow through that region is. Let's dive into what took place last week. Here are your headlines. As expected, the Federal Reserve kept its benchmark Fed funds rate unchanged at 3.5 to 3.75%. This follows a similar pause in January after three rate cuts late last year. Now, while the Fed funds rate doesn't directly set mortgage rates, it strongly influences borrowing costs across the economy. So, what is a bigger takeaway? The decision to hold was widely anticipated, but it wasn't unanimous. Governor Stephen Miron supported another quarter point rate cut, highlighting the Fed's balancing act. Inflation remains above target, limiting the Fed's ability to ease policy, while signs of a cooling job market may increase pressure to lower rates in the months ahead. The Fed also pointed to uncertainty around global events as a potential risk to the U.S. economic outlook. Now, in housing news, new home sales fell nearly 18% from December to January, reaching a 587,000 annual pace. While this is below expectations, the drop follows stronger sales in November and December, with January's harsh weather likely playing a role. Builder sentiment remains cautious. The National Association of Home Builders Housing Market Index edged up 1 point in March to 38. Readings below 50 indicate more builders view conditions as poor than good. Affordability challenges and higher construction costs continue to weigh on confidence. So, what is the bottom line? While the monthly drop in signed contracts drew attention, the broader trend tells a steadier story. The average pace of sales over the most recent 3 months of 688,000 is very close to the prior 3-month average of 692,000, suggesting overall demand hasn't shifted dramatically. Now, wholesale inflation came in hotter than expected in February. The producer price index rose 0.7% for the month and 3.4% year over year. Core PPI, which takes out food and energy prices, also topped forecasts, increasing 0.5% monthly and 3.9% annually. Now, on the labor side, initial jobless claims fell by 8,000 to 205,000. However, continuing claims rose by 10,000 to 1.857 million. What we are continuing to see here is people taking a bit longer to find solid, full-time jobs, and in some cases filling the gap with part-time or gig work that doesn't always get captured in the numbers. This week should be relatively quiet when it comes to scheduled economic data, with jobless claims on Thursday being the main report to watch. That said, I wouldn't expect the markets to be calm. Most of the volatility we're seeing right now is being driven by headlines and real-time updates around the conflict. Investors are reacting quickly to new information, whether it's comments from the president or development overseas, which is causing markets to swing day to day. Until we get a clear, concrete signs that this situation is stabilizing and that the flow of oil can continue without disruption, this kind of volatility is likely here to stay. Right now, uncertainty is the main driver. Hopefully, we'll start to see some resolution soon and can get back to the momentum we had before things escalated. I'll keep you posted with another update next week. Hope you have a great rest of your day.